The sudden collapse of the Silicon Valley Bank has added another layer to volatility to the already highly volatile markets across the globe. Depositors, entrepreneurs, and companies are making swift flights to safety, turning to the big players deemed safer than the smaller counterparts. For an analysis on the impact of the Silicon Valley Bank fallout at home and abroad and its possible effects on future interest rates, we now connect with Professor Yang Jun-seok at the Catholic University of Korea. Good morning, Professor Yang.
Good morning.
So this has been the top headline in the economy section for over a week now, and we have to elaborate on this front. We couldn't think of a better person to reach out to than you. U.S. regulators have ensured that SVB, the Silicon Valley Bank depositors, that all of the money will be protected by federal deposit insurance. The U.S. Treasury Secretary Janet Yellen also reassured that the U.S. banking system remains sound and that the Americans can feel confident about their deposits. There were some outcries and concerns about the failure of the system at large. Can you first tell us what measures are being taken after the tech lenders collapse?
Okay, well, as you mentioned, the U.S. Federal Deposit Insurance Corporation has extended their loan, their deposit insurance. Usually they only insure deposit amounts up to $250,000, but in SVB's case, they did say they will cover all of the deposits. While this is against the usual FDIC rules, they do sometimes, when they think it's warranted, do protect entire deposits. And then the Fed has established the Bank Term Funding Program. Banks facing liquidity problems, not enough cash, they can borrow cash using their government bonds or high-quality debt owned by the banks as collateral. The big advantage for this particular funding program for the banks is that the value of the bonds which are used for the collateral will be calculated using the face value of the bonds rather than not the current value. The current value having fallen so much is what got SVB into trouble. So when banks are taking loans from the Fed, it will no longer have to worry about the value of the collateral or the government bonds. In addition, banks are taking the more loans out from the Fed using the usual discount window. Banks took an all-time high of $153 billion from the discount window as of Wednesday, and they're also taking using the bank term lending program that I just talked about to loan out additional $12 billion. So they're getting a lot of cash in the banks to prepare for liquidity problems such as bank runs. Now, to prevent possible bank runs as well, since if banks are seen as borrowing too much from the lending programs, then the banks may be seen as weak. So the Fed will not release the information on which banks borrowed money from the various facilities until next year. So they will be keeping some transparency aspects, but they're weakening it so that the situation, the instability will not be worsened. And then politicians and bureaucrats from both the U.S. parties are trying their best to retain confidence in the U.S. banking system. This includes President Biden as well as various congressmen. And there are discussions to extend tough regulations on large banks to medium-sized banks as well. In 2018, President Trump had loosened regulatory requirements for banks which have assets below $250 billion US dollars. Those are considered medium-sized banks in the United States. The SVB had $209 billion in assets. Signature Bank, which also failed, had slightly less than that. So these banks were not subject to really tough regulations. But the understanding at the time was that these smaller banks do not have national systematic risk they're not large enough. But the current understanding now is that they can have a major impact on the economy, so perhaps they should be subject to tougher regulatory requirements. And finally, there are voices saying that deposit insurance should insure total amount of deposits rather than limited at $250,000. Since for SVB, they did decide to insure the entire amount rather than just up to $250,000. Higher capital requirements for banks are also being discussed in the United States. In Korea, we already have started to move toward this goal, having banks more capital in their balance sheets. Banking industry groups are generally opposed to these 2 points, having higher capital requirements and higher deposit insurance, as well as higher regulatory requirements, since this would require banks to pay higher premium for their deposit insurance or reduce their profitability. But the problem here, in some ways, may be that if there is no further problems in the next week or so, then everything may settle down and things may go back to normal and not much may be done. Now, there are some problems, additional banks which are experiencing some problems, like the First Republic Bank, but First Republic banks are being bailed out by other banks. There are also problems with banks outside the United States, most notably Credit Suisse. But Credit Suisse was considered the weakest of major international investment banks for the last 2 or 3 years. So it may not be that big surprise that they've got themselves into this trouble. They're now being bought out by the other major Swiss International Investment Bank, the USB, but after the USB announced purchase of Credit Suisse, their stocks fell by 5%, though it did recover afterwards. I think it does show that the international, not only the United States banks, but international financial institutions are now very nervous. Investors are very nervous about the banking industry. So we will be continue to see some large changes in the value of the stocks. But as long as we don't see a major bank runs in the next week or so, there's a very good chance that all this will die down.
I think it's also important to note that the Silicon Valley Bank is only America's 16th biggest bank. As you've said, perhaps we'd suspected that the major impact on the economy might be limited, but that's not the case. It's already having a ripple effect in the U.S. and in Europe. U.S.-based First Republic Bank and Europe's Credit Suisse, as you mentioned, were the latest bank in peril. Although Credit Suisse was again salvaged by UBS, an emergency rescue deal. How do you gauge the SVB contagion risk on other banks in the U.S. and in Europe from this point on going forward?
Okay, well, we need to look at 2 points. The first is the underlying fundamentals, and the second is the risk of bank runs. And during the first point, the fundamentals, most banks have similar problems with SVB to a smaller extent. Most banks have invested in government bonds because government bonds are considered very safe bonds. And until last year, when the Fed started raising the rates, if you have low interest rates, you have higher value of government bonds. So they made, in some sense, perfect investment for banks. And because of that, a lot of banks loaded up on government bonds, and they're causing similar problems with SVB because interest rates now have gone up and up. The value of these government bonds have come down, and that have reduced the asset size of these banks. It has also caused some cash, some shortages, because banks now have to make up cash for that reduction in assets. And for SVB, that's what signaled that SVB may not be as strong as other banks. But what made SVB different is that they really had bad risk management system. For nearly a year, they did not have their risk management team in place. And even before, the Fed had caught some problems with SVB. The only problem was that the Fed perhaps thought that they did not have the authority to really go after SVB's problems because of the weakened regulations after 2018. Again, tougher regulations for these mid-sized banks are being thought of. Then second problem is the bank runs. Bank run come when people have deposits, especially uninsured deposits above $250,000 in certain banks, and people get the idea that this bank is in trouble. Now, that depends more on psychology than any economic fundamentals. No matter how the bank no matter how the bank is actually strong, if there's a lot of rumors coming around that this bank is weak, you want to withdraw your money as soon as possible because you may not get the money back after the bank collapses. This is part of the reason why the Federal Deposit Insurance is thinking about insuring entire deposits rather than just up to $250,000. This was also another problem for SVB in particular because because a lot of the depositors here were big tech firms, they were able to get panic messages out quickly through SNS like Twitter. And the entire collapse only took 36 hours. And this is probably faster than any other bank runs that we've seen in the United States.
Of course, for our local listeners, the biggest question was, what impact will the Silicon Valley Bank collapse have on South Korea? Now, South Korea's financial regulators have vowed to ensure that the SVB collapse doesn't cause systematic risk at local financial market. But they also said they'll continue to seek ways to break the oligopoly of major commercial banks here at home by spurring the emergence of diverse independent banks. While the government says the SVB collapse will have limited impact on Korean banks and companies, how concerned are you as an expert, Dr. Yang?
Okay, well, Financial Supervisory Service said that they will raise capital requirement for banks, which is a good move. Banks can withstand higher losses in their portfolios. But bank runs are psychological rather than economic, and Korea has fairly low deposit insurance. Right now, deposit insurance caps out at 50 million won per deposit. That's only about $38,000. So raising that limit may be necessary. Some people are worried that if Korea does introduce niche banks, which is what this current government wants to do, niche banks are specialized mid-sized banks that may provide more competition for banks. But it's notable that even with all the problems that we've seen in SVB, many tech CEOs still praise Silicon Valley Bank because it was one of the few banks which fully understood the problems faced by new tech startups. So the niche banks could probably do a lot of good for Korea, but depositors should spread their money around in various banks. One of the problems with SVB was that these tech companies, which had these great relationship with the Silicon Valley Bank, kept all their money in SVB, and because of that, a lot of their money was uninsured because they just put too much money in that bank.
Now, one remaining question is what will happen to interest rates in light of the Silicon Valley Bank collapse. Now, despite the Credit Suisse shock, the European Central Bank hiked interest rates by 0.5 percentage point, saying Europe's banking sector is resilient with strong finances, plenty of available cash. How do you see this? And do you expect the United States Federal Reserve to also raise rates this week?
Okay, while the U.S. 12-month inflation for February did fall for both headline and core inflation, if you just look at inflation over 1 month in February, headline inflation did fall from 0.5% in January to 0.4%, but core inflation actually rose from 0.4% in January to 0.5% in February, mostly due to rise in the price of shelters. Now, 0.5% is actually a very high inflation rate. If you annualize that, that comes to about slightly more than 6% per year. So there is definite reason to raise interest rates. So if we don't see another case of major bank run in the next few days or so, then the Fed will probably have to raise the interest rate further. So they will probably go for a 25 basis point increase, which was pretty much expected even before the problems at the Silicon Valley Bank. Where I think it will make a lot of difference is that the Fed will also publish their dot charts during this week when they make their announcements. And the big question here is the Fed was not expected to raise the rates during the second half of the year, but the current market is thinking perhaps that they will raise the rates for the second half of the year. So how much and for how long? And my guess would be that they will raise the rates by additional 22 baby steps in the second half of the year, but we'll have to wait to see the dot charts.
Thank you very much, Professor Yang, for today's conversation. We'll speak to you again next week.
Thank you.
If you're listening to our program using the podcast service, just a reminder that we do go live Monday through Friday, 7 a.m. Korea Standard Time. So tune in and help us make the show more informative by giving us your input. See you bright and early on Good Morning Seoul.